Hey everybody, it's Christopher Small with CMS Law Firm, and today I wanted to talk to you about tax basis. Before we get there though, if you are listening to this or watching this, you can hear me, please let me know in the comments. Just say like, hey, I can hear you, or it sounds great, or you look terrible, whatever you want. That'd be great. Just so I can make sure I'm not talking to myself. But today, the day of recording of this is April 15th, the magical day that all of our income taxes are due. So I thought I would take a little bit of time today and explain an important estate tax planning concept that comes up often and is often a source of critical mistakes that result in families losing lots and lots of money because they think they're doing the right thing, but because of the way that tax basis works, particularly when it comes to estate planning, they miss out on an opportunity to save thousands, often tens of thousands, often hundreds of thousands of dollars in income taxes because they haven't really considered tax basis when they are making decisions, right? Before I get there though, I wanted to let you know that if you want to talk more about this or any other estate planning things in general, if you want to talk to me about it for free, you can go to estatemeeting.com and set up a time to talk to me, all right? So let's talk about this tax basis issue, question, definition. So whenever you buy something, whether it be a piece of real estate or a stock or anything else that has a defined value, whenever you buy that thing, that establishes its tax basis, okay? So for purposes of what we're talking about, let's use like a piece of real estate, and we will assume that you buy this real estate for $100,000, okay? Let's say it's a house, depending on where you live. It could be a nice house or a not nice house. If you're in Seattle, it's probably not a nice house, but right now at least, that's okay. So you buy this piece of property for $100,000, and let's say maybe your grandmother bought it in 1970, okay? And it stays in the family. She lives in this property her entire life. Her kids grow up in it. Maybe now you're a grandchild, right? And maybe you've gone over there for Sunday dinners or whatever. It's a great house. And now that grandma is getting old, she wants to make sure that the house is passed on. She's concerned with avoiding probate and things that go on there. So she decides that she is just going to give the house to her favorite child, Fred, okay? So she has an attorney draft up a deed, and she gives the property over to Fred, thinking that, this is great. I'm going to avoid the costs and fees of probate, and I'm not going to do all this stuff, and it's going to be wonderful. And it is pretty wonderful right at that time. So Fred takes the property. It's a gift, so there's no tax due at that time, and everybody's happy, and it's all good. But in the future, Fred decides that he wants to sell the property. It's time to get rid of it. No one in the family wants it anymore. Although we wish this didn't happen, it does, okay? Fred goes and tries to sell the property. The property now, it's 2019. The property is worth $1 million, all right? So it has, actually, let's make it this way. The property is now worth $1.1 million, which means that now there's been $1 million of gain in the value of the property from the time that it was bought to the time that it is now being sold, okay? Hopefully you're still with me. If you are and you're listening, maybe just say, hey, I'm still listening, I get it. That would be fantastic. Or if you have questions, let me know. All right, so we're at $1.1 million. Fred is going to sell the house. He sells the house, makes the transaction, everything is great. He's got $1.1 million in his pocket. Everything is feeling good until this time of the year rolls around, tax time. He gives all of his documents to his accountant, and the accountant goes to work, comes back and says, Fred, we have a problem. You owe the IRS $200,000, okay? And Fred is like, what? $200,000? I was not anticipating that, and I don't want to pay that. How can I avoid that? And the accountant says, I'm sorry, Fred, you cannot avoid that because you have made a critical mistake. You did not think about tax basis when the grandma gave Fred the property, all right? Here's the important part, by the way. I'm finally getting there. Hopefully you're still listening. When grandma transferred that property to Fred, she also transferred the basis in the property. So she bought it at $100,000. Fred takes it at $100,000, which means when he sells it, he's gonna have to pay tax on all of the gain over $100,000, okay? Here's why this is a critical thing to know when it comes to estate planning. When someone dies, okay, and a property is transferred to someone else, they get what is called a step up in basis. So and what that means is the person that receives the property after the person has died receives the property at present day value and does not have to pay tax on any of that gain. So to put this into perspective, if grandma would have waited until she died to give the property to Fred, then Fred would have taken that property at $1.1 million in value. When he sold it in the future, he would not pay tax on any of that $1 million of growth, okay? He would have saved essentially $200,000, $150,000, depending on the specific circumstances around the tax, but many thousands of dollars he would have saved if grandma would have waited to transfer that piece of real estate to Fred. Now, you may be saying, okay, that's great. And by the way, if you have questions about this, if you have concerns about this, and you want to talk about your specific situation, estatemeeting.com. Go there, estatemeeting.com, set up a time to talk with me or with somebody in my office. It might be somebody else, and talk to us. We'll answer your questions. We can give you advice on what to do so that you can avoid these problems. Now, you may be thinking, oh, that's terrible that they got to pay this big tax, but they got to avoid probate, which is pretty nice. And I'm going to tell you this, a little nugget. You can avoid probate in this situation very easily and cheaply and simply. So if you want to know about that, also get on the phone with me. I can tell you about it, okay? But tax basis is important. And this rule, this step up in basis is what it's called, applies not only to real estate, but it applies to stocks. It applies to anything that you're going to be inheriting that has a tax basis from a long time ago, or even from a short time ago. And this comes in really handy when you have Microsoft stock and Boeing stock and even Amazon stock, things like that, where somebody acquired them as they were working in the company, for example, and then they give them to you. If they do that after they pass away, then you get that step up in basis, and that gift multiplies on itself because you don't have to pay any taxes. All right, that is it. Hopefully you got your taxes done. Hopefully you got a big old fat refund. If you didn't, hopefully you didn't get a big old fat refund because you made a bunch of money. And but don't forget to file. Even if you extend, okay, get her done. Don't wait. Nobody wants to pay penalties and things like that. So get them done. Thank you so much again for being here. Christopher Small with CMS Law Firm. Again, if you want to talk to me, go to estatemeeting.com. If you know someone that would want to hear this or needs to hear this, share it. If you like it, hit the like button. And that's it. I'll see you again here tomorrow. All right? Bye.